folks, David Waring and Mark Prosser here again with LearnBonds.com for this week's $200 billion worth of bond advice, the show where we talk about everything PIMCO. This week I've asked Mark if we could start off with a video that we actually found, CNBC interviewed with Mohamed Al-Arian, who is actually the CEO of PIMCO.
So the dilemma for the Fed is like what everybody's having with the replacement officials in the NFL. We know they're not first best. We know that they are not the best ones out there. They are second or third best, but we expect them to be perfect. And that's the problem that's occurring with the Fed. We know that the Fed doesn't have the right tools to deal with the problems. They need help from other government entities, but other government entities are literally on strike. They're not coming in. So the Fed is involved, but the expectations are so high that the Fed is not going to be able to deliver on economic outcomes.
I thought what you said about the NFL referees was quite interesting. Not a perfect metaphor. I'm not sure if he's a sports fan, but I think the message is very good. The message that monetary policy is not the best way of promoting economic growth, and essentially that they really have to use the tool in a kind of chaotic fashion in order to get the results they want. What Mohammed is implying is, if they can do this for a while, if they do it for a while, and and the government, the U.S. government, or the other governments of the world start doing their part, it's not going to be so bad. But if the Congress and the President is not able to help the economy, and the Fed needs to keep doing that, then run for the hills.
How do you invest around it if we do see something materialize?
Carefully differentiate what the Fed controls directly, so they can impact valuations on the mortgage market, they can impact valuation in the treasury market, they can suppress volatility, and what the Fed can only impact indirectly, where you're going to expect a lot more volatility. So scale it properly. Second, spend a lot of time differentiating, because we're going to see a lot of differentiations going on within asset classes. And finally, be careful of the tail risk. So it's very much a differentiation story. This is no longer simply betting on the market for the removal of the tail risk, which is what the story has been.
What do you think he's talking about when he talks about differentiation?
I think he actually was pretty clear. The Fed has a lot of control over treasury prices. It's got a lot of control over agency mortgage-backed securities, but as you start moving into corporate bonds, they have a lot less control. As you start moving into stock prices, they have a lot less control. As you start moving into economic growth. So what he's saying is, the Fed will continue to be able to impact the price of treasuries. What they won't be able to continue to impact is having whether the stock market rallies or not.
So they might actually lose control of some things faster than others if inflation kicks up and things like that.
Totally harmful.
Sounds good. So that's a nice segue into the Twitter segment of the show. And I think probably the most interesting tweet that I saw all week was this one, where Bill Gross says, "Ride the Fed and the ECB's central bank wave, but be mindful. Waves crest and ultimately crash." So what do you think he's saying there?
I'm not sure if that's a prediction or a haiku. But I think it's a repetition of what I said in the video. It is at some point, it's good for now, but this is not a sustainable situation. And the question is, when will that wave stop rising and lose momentum and fall back? And that's the real thing. It's really, he's basically saying, now's an important time, the time to
Okay. So, moving over to Learn Bonds then, what are we putting out on Learn Bonds this week in our weekly PIMCO article?
Well, actually, the theme was inflation, and PIMCO funds that fight inflation.
Right.
So there was one fund that I think actually would give you a post-inflation, or I should say post-inflation, if inflation is a modest level, will give you a positive return. And that's the HYS fund, which is a 0 to 5 year high-yield bond fund. And that fund is yielding about 4.25%, 4.5%.
Wow.
So but it's a high-yield bond fund, which means default or risk.
Right. Okay. So what I'm hearing from you is you don't like the PIMCO ETF TIPS fund, but you do for inflation fighting. But what you do like is their high-yield short duration fund.
Well, they have 3 TIPS funds. I don't like